This is an explanation on Dave. Dave is a fintech company that I am currently invested in, and this is my investment thesis behind it. First of all, Dave is a very small company. Its market cap is only roughly around $3 billion, which is like really small if you compare it to the rest of the companies that we have. So, as always with small companies, the price is always going to be very volatile. So, what is Dave? Dave is a more or less a online banking company that seeks to replace payday loans and other short-term, like really high interest lenders. One of the cool features about this app is called Extra Cash. Basically, with Extra Cash, you can get up to $500 worth of cash for a small fee and nothing else. This is quite a very interesting product. There's no credit checks to do it. I think everyone get at least one shot, and I think it's a very interesting business model. Overall, Dave caters towards people who have cash flow issues. Usually, that does tend to be lower income Americans. Dave is part of this new group of fintech companies called Earned Wage Access. What they do is they try to front load your paycheck a little bit earlier than usual. So companies like SoFi and Chime, what they'll do is they'll look for the ACH transfer request to send money into your bank account. And then once they receive that request, even though the money has not arrived in your bank yet, these app will make it so that they'll trust that information and just front you the your paycheck just a few days earlier. And for the most part, this is actually a fairly valuable service. As someone who works at a retail bank myself, what people will do is they will come in and certify checks so they can have some access to the funds a lot earlier. The bank does charge a fee for $15 to get that check available for you right away. In order to like certify the check, and yeah, the banks do make a lot of money by doing that, and there is a demand for it. But what is unique to Dave is this $500 extra cash, and I'll be comparing Dave business models to Chime and Sophie, and we will compare the financials and my reason why I think overall Dave is a better investment compared to the rest of them. But first, we're gonna watch a very interesting YouTube video. This video is from the More Perfect Union. In my opinion, I think they're more or less a left-leaning think tank. They tend to advocate for social justice. They tend to advocate for like against big corporations, for unions, that kind of stuff. Politics, aside, or beliefs aside, this video is a hit piece against companies like Dave. So they are speaking out negatively towards it. It happens to show up in my YouTube feed, and based on this video, after looking at their business model, I really wanted to invest in this company. Let's just start with the first section over here.
At one point, Earnin made you click 13.
The first section is just a note about how a portion of the revenue is made. I'm going to show you this very quickly and address it very quickly.
15 times to opt out of tipping. And the Dave app messes with your emotions, telling you your tip is going towards helping hungry children. As you decrease the tip amount, you make the little animated child sad by taking her...
So one of the features on these apps, but Dave does not do this anymore, was a feature called tipping. Basically, these are essentially digital payday loan companies. They front load you your paycheck, and then you have an option to tip them, which is absolutely absurd. And Dave has gotten rid of these features, and they were able to maintain their strong revenue growth. So this feature is now gone, at least for Dave anyways. I mean, I think this was kind of predatory and unnecessary, but I'm glad we got rid of it. So this is no longer a concern.
So when I heard this, I was kind of like, okay, this just sounds like a payday loan where you borrow a few $100s and pay it back with your next paycheck, with lots of interest, of course.
What are the interest rates? Damn, I thought that was the year of establishment.
But all of the EWA app users I talked to said they would never consider taking out a payday loan.
I grew up seeing people use them, and
the energy is already kind of like down, feels kind of loan sharky. They're always in buildings that are not well kept, abandoned shopping malls.
The apps, on the other hand, have bright colors and clean design. You can download them right from Apple's App Store and on Google Play.
So one advantage of these apps that is that it looks cleaner, right? You don't have to visit a physical location. Everything is done digitally. That's a really big appeal in using apps like Dave. I believe the other one was called Earn It. And then that's true for SoFi and Chime as well, right? They don't look like payday loans, but they are offering a very similar service, and you don't have to go in person. So when you visit a payday loan location, it generally does not mean a good thing. So, you do remove that aspect of it, and I think that is part of the appeal.
Download them right from Apple.
Bathroom. Next to the OSHA signs.
Lee saw an ad for an app called Daily Pay at the school they worked at in Kansas. Daily Pay is one of the EWA companies that partners with big corporations like Amazon, Target, and McDonald's to offer paycheck advances as a benefit, like PTO or health insurance. So Lee signed up, the school
Like, I fell for this. I didn't see it as a loan. You're not like signing stuff. You're not sitting and reading through a loan agreement. It's just like, it's instant, it's fast, and it seems cheap.
It seems cheap. A lot of people
You're
Okay, now we're going to get into the very interesting part on how Dave makes money. Now watch this. Pay very close attention.
not sitting and reading through a loan agreement. It's just like, it's instant, it's fast, and it seems cheap.
It seems cheap. That won't give you the full picture. What you want to do is calculate each loan's APR, or annual percentage rate. I know, this equation looks scary, but
Guys, I hope you're paying very close attention. This is very important. This is very fascinating.
if you took that as a payday loan, that would likely cost you $15 in fees, and it'd be due back in 2 weeks, 14 days. The APR would be 391%. That's expensive. Credit card cash advances usually top out around 36%. So what if you took that $100 out from Earnin instead? Well, Renita actually did that yesterday, and I asked her to calculate her APR. Her only fee was that small lightning transfer fee of $3.99. But she's going to get her paycheck tomorrow, and even if she needs the money for something else, Earnin will take back what she owes right away, so she only has 1 day to repay, which means her APR is
1,456.35%.
Okay, so that was a little bit of an extreme example. Typically, it's not going to be that high, but in the example with Earnin, APY can be that high. So effectively with Dave business model, you are going to get a effective interest rate of anywhere from probably from 300 to 600%. And that's probably true with payday loans as well. And the way that they structure it or do it, like, you don't even think about the APR, right? Like if you said to me that this loan has an interest rate of 300% for the past, like 2 weeks, you're probably not going to take it out. But if you're going to say to get like this $200, you had to pay like a, $8 fee or whatever, right? You don't really think about the interest rate in that instance. So it's a really good way, to disguise how really expensive it is, and sell that to the people who really needs it. And this is true for all business model when serving people who are not very credit worthy. It's just how they do business, and they do make a lot of money from it. Whether it's ethical or not, that is not the debate here. I am making an investment in this company. I just like good companies that make a lot of money. So
workers can only access their own money.
Their own money.
It is absolutely not a loan.
Because our product is not a loan, no EWA provider charges interest.
There is no interest.
We do not charge any late
Pay.
They have literally forever to pay it back, right? So because it's their money, they're just borrowing against their future self. I shouldn't say borrowing, they're accessing wages against their future self.
So what you saw here is a bunch of lawyers discussing why companies like Earnin and Dave, why this feature is not considered a loan. Now, what they are doing is that they're detecting the ACH transfer into your account, and then they're just fronting you the money early. And for the most part, that is kind of a loan because they technically don't have the money in their accounts yet. but the way that they portray it is that like they saw the initiated transfer, they trust them completely, and so that the company is just willing to give you the money. And these lobbyists are really good at using these language to try to talk to lawmakers into thinking that this is not a loan. And for the most part, it has worked out so well. And under the current Trump administration, I really don't think that there's any. I really don't think that there's going to be any major legislative action against these types of companies. Let's get real. That's just the kind of person Trump is, right? And I don't mean to get political here, but I do think he is a little bit corrupt. So, I don't think he's just going to go after that. But should a Democrat come into power, I do think there will be a little bit more regulatory scrutiny against this type of business model. So, but as of right now, I do view it as a good investment, largely due to the growth of the business, how profitable it is, and the loose regulatory conditions that we are currently under, during the Trump administration. And for the most part, that covers the business model of the companies. And now let's get into more of the financials. So Dave is a really fast growing company. It is growing 64% revenue year on year currently. Profits grew at 32%. Here we have the 3-year revenue growth. And then here we have the total number of members. This is the extra cash origination volume. So this is their, fronting you the $500. No question asked. You just pay a fee. And you can see that the volume has been increasing exponentially. Given the economic situation in the U.S., I believe demand for the services like Dave might be accelerating rather than decreasing, because the labor market is a little bit choppy. The Fed is reducing interest rates. A lot of people who have high income, they're not necessarily good at saving that kind of money. They might go through that very quickly, and you'll be surprised at the amount of people who make 6-figure incomes with poor credit. It is a very common occurrence, actually. Trust me, I've seen it a lot myself. So $3.2 billion. The current price is $240. As you can see, the price is very volatile. It ranges between around the 250 all the way down to like the 190-ish. It just ranges between there. So swings of 25%, between months is very normal for the stock. And of course, with all small market cap stocks, it is always extremely volatile, and it's just a risk that you have to take. So in the last quarter, it had very strong revenue growth. The company is currently profitable. Cash flow is going up. There is a little bit of problem with the share dilution of the company. However, more or less, this isn't too bad for given like how fast it's growing. With operating expenses, you can see that it has remained flat, so they are experiencing some of that operating leverage. But we look over here, so this is a total number of members. They do have an access of a 13 million customer base. Of course, this one has been slowing a little bit, but if we compare this customer base to the other companies, I do think Dave does have an opportunity to branch out in the future. Looking at the PE ratios, in my opinion, this company is not expensive. This is currently trading at a 63 PE ratio, and it has a forward PE ratio of 20. So rough estimates, in 1 year's time, the forward PE ratio is expected to compress by 66%, which is massive. And keep in mind, this company is still very, very small, so it has a lot of potential to grow in the future. And here on Tip Ranks, we have the analyst price targets for the stock. You can see that the average is 280 with a high of 320 and the low of 229. So the low is actually not too bad compared to the rest of other stocks. It looks like as the stock is concerned, there is a lot of agreement between the analyst and the current stock price. And I do think there's much more potential for it to grow. So there's currently 7 ratings and all of them are a buy. And the most prominent raters all agree too that for the most part it is a buy. So why did I choose to invest in Dave rather other companies like SoFi or Chime? So Earnin is actually not publicly traded, so we're not able to see their financials. So Earnin is just not an option for me. But if we compare Dave to a company like SoFi, for example, so I also want to do a comparison of Dave versus other financial companies. So the first one we're going to take a look at is SoFi. So we look at SoFi, revenue grew by 39%. Dave is growing faster. And if we look at the PE ratio, although the current PE ratio of Dave is higher, the forward PE is much lower. But again, Dave is a much smaller stock, so the net income is going to fluctuate a lot. It might even go negative, but overall, I think that because of Dave's growth and their more focused business segment, Dave is inherently more valuable relative to his size because of that. But but if you look at the amount of members, of the amount of people that SoFi is with, is actually roughly the same amount of members. So SoFi currently is able to extract more value from the members, but of course is also trading at a higher price because of it. But I think because of that, Dave does have the more potential to branch out the customers with new products and services that they might need in the future. Now, I also want you guys to consider this. Despite its size, right? SoFi only recently turned a profit in Q4 of 2023. Dave is already able to turn a profit at a $3 billion market evaluation, at a market cap. So despite being so much smaller, Dave was able to generate a profit. Meanwhile, SoFi was not able to. Now, this is because SoFi was able to offer more services. So I guess, investments in CapEx is going to be much higher with SoFi, and they hope to get a larger return in the future. But because Dave has a more focused business segment towards those customers that really have cash flow needs, I think that just because that is separate, it is inherently more valuable of a company. And if we look at the revenue that this business make, currently 961 million, and then we compare that to Dave, is currently at 131. And then if we look at the market cap relative to SoFi, which is roughly around 10, meanwhile the revenue ratio is a little bit less than 10. So right now the market is evaluating Dave on a per revenue basis cheaper than SoFi, despite the higher revenue growth. And then I just want to take a look at probably the closest publicly traded company that is a competitor to Dave, which is Chime Financial. Right now, they are not able to consistently make a profit. So you can see that they did have, I believe, I don't know if they made a profit. Oh, they did make a profit. So right now, they had 3 quarters that they made a profit on Chime. This is trading at a higher market evaluation. So Chime is valued twice as Dave. They have less members, and they make less money. In terms of revenue, they are a little bit higher on the revenue side. You can see that Dave does trade at a premium on a revenue basis compared to Chime. And in my investment philosophy, I do value that higher quality business more. I know on a per revenue basis, Chime looks cheaper, but they are having profitability concerns. So the fact that Dave, at a much smaller market cap, is able to generate more profit with less revenue means that Dave does deserve to be traded at a premium on a per revenue basis compared to Chime. And and with Chime's business model, I mean, just look at the share dilution. That is just ugly. So, but I don't know what the market holds for Chime. I think I'll do a little bit more research on the stock. But I just really want to get this out before earnings come out for Dave, I believe on November 4th. But I do think Chime will do fine. I think this has the potential to outperform the market. I will do a little bit more research on this stock. But as of right now, I do think Dave is a much better investment. This is all I want to say about Dave. Again, my position in this company is not very large, probably only around $3,000 to $4,000, which is like not even like 2% of my portfolio. I think this stock does have the potential to 10x, 20x, hopefully. But yeah, I think this is a fairly decent company, a great bet. Now, in terms of the ethics of the company, I do understand the predatory nature of payday loans, but they do offer a service that is kind of needed by certain people. I'm not going to debate too much of the ethics about it. As an investor, the way I see it, it is a voluntary exchange, right? People are willing to pay that money in order to get their services. So it is just what it is. So Again, I'm keeping this as a very small position. I view this as a very high risk investment. This is not as safe as companies like Google or your Microsofts or your Metas. So just keep that in mind.